What is up, YouTube? This is The Working Investor. In this video, we're going to talk about looking at risk management and diversification of portfolio with the lens of correlation coefficient, looking for uncorrelated assets that perform. And here's the crossroads where it's very hard to find something. It's easy to find something that's somewhat correlated to the market or very correlated to the market and gives you market-like return or greater, but it's harder to find assets that are less correlated to the market, and if I dare say, even negatively correlated to the market, and still gives you amazing return, at least comparable to the market, because it's not that difficult to find something that's diversified and uncorrelated to the market and gives you kind of very, very, very subpar return. So that's a very, very hard box to check. And that's what I've been doing in my research, and I'm sharing my research in this video. Let's get into it. So we're just going to go over a couple little definitions of correlation and correlation coefficient. I'm sorry about the little, technicality, but it's important to know. There's something called correlation, which means things that move together, especially when we talk about the market, when stocks work in tandem. And there's something called a correlation coefficient, which tells you what degree it's correlated to uncorrelated. And it goes from 1 to -1. So 1 is like a perfect correlation where something moves in the exact same direction and with the exact same magnitude. And a -1 means something moves perfectly inverse, which moves the exact same opposite direction with the exact same magnitude. And something very, very important to note is the correlation when you compare stocks and underlyings is that they can be dynamic. That you can have certain periods of time where the correlation coefficient could be stronger or less as strong. So that's very dynamic. And also past performance is not indicative of future gains. And, this is not any type of advice, whether it's tax, legal, financial, or, please see all my disclaimers and consult who you have to consult. So let's look at reference over here. The S&P 500 and the NASDAQ. I used to think that if I have some money in the S&P and some in the NASDAQ, I'm diversified. Nothing could be further from the truth. And it's actually not very diversified because they're actually 85 to 95% correlated. They're extremely correlated. The correlation coefficient is 0.85 to 0.95. They're very, very, very correlated. As a matter of fact, the S&P 500, heaviest sector is very, very heavy in tech, about 32 to 36% weight of tech. And I guarantee you that almost all the tech that's in the S&P, you're going to find it in the NASDAQ, because the S&P is the largest tech and the NASDAQ is the highest momentum of tech. So it's correlated. It's not really a perfect diversification. And then I try to compare the S&P to the IWM. Obviously, like S&P's large cap blend and the Russell 2000 is small cap blend. So large and small cap are different underlyings, which is true. There's probably no overlap with companies, most likely. But, unfortunately, the correlation coefficient is a little better, but it's not perfect. It's 0.83 to 0.86. I looked at ChatGPT and they had some sources. I went deeper into the sources to take a look. So it varies, but it's somewhat correlated. It's a little bit better diversification, but somewhat correlated. So, like I said, I did find many underlyings that have some positive correlation, some positive correlation coefficient, and they beat the market. A very good example, and I'm actually looking into this myself, is Berkshire Hathaway. So basically, you could trade like Warren Buffett, just buy Warren Buffett's portfolio. So Berkshire Hathaway has a 0.51% correlation coefficient. So what does that mean? It's moderately correlated, not severely. As you can see, it's less, but it's a very powerful contender. It had many, many years where it beat the market. Actually, right now, I could show you an example. So you can see right now, I'm looking at SPY, S&P 500. We're looking year to date from January 1st, 2025 to today, which is mid-March. And you can see, of course, everyone knows the SPY is down about close to 5%, right? Let's compare that to Berkshire Hathaway. So looking at BRK.B, this is the fund for peasants like us. Basically, if you look at year to date, you'll see that instead of being down close to 5%, 4.6, whatever, it's up twice as powerful as that. It's up 12.82%. So you can see that crazy divergence, right? But something that I really wanted to note over here is that actually Google Finance has a really good illustration. So if you look at the 5-year chart of Berkshire Hathaway, which is in blue, and you look at the S&P 500, which is in the color yellow, you can see that many, many times, they kind of worked in tandem a lot of times. And you can see here, there are certain periods, most notably in the past year, there has been a divergence. Let's look at the 1-year chart. And you could see here they're in tandem, right? But here you could see a polarization. There's a divergence going on. September, right? You see how the blue is up, which is Berkshire Hathaway, while the market is down. And you could see that again, especially over here since the year began, that there is like definitely a divergence going on. That's what I mean by, moderate correlation coefficient, that it does correlate somewhat, but there definitely is some divergence. So I like that. And I like it that it beats the market. Let me show you. So here's the chart I showed you earlier from Seeking Alpha. And I'm looking at total return because SPY does have a little dividend. So I want to put everything into consideration. Looking at the 5-year chart because I want to look as far out as I can with a free version. And I can see here that basically in the past 5 years, the S&P 500 return was 153.1%, right? Compare that to Berkshire Hathaway, Berk.B shares. They actually beat the market. It's 189.48%. So here I can have a fund that is somewhat moderately correlated, but it still beat the market. That's something that I like. So let's look at other underlyings. So I looked at commodities. I looked at CLOs. I looked at business development companies. I'm looking at other different places where I can put money, and within each other sector, which one specifically shines. From the commodities, I found that precious metals commodities like gold and silver, they performed better. Again, past performance not indicative of future gains. So let's just add in gold and silver. I'll show you. So I added gold. Let's add silver too. Silver, precious metal commodity. And there's a fund called CTA. It's a new fund that came. Well, actually, it's only recently, so it doesn't have a lot of history. So let's just see over here. Let's update chart. So you can see here, because gold, so GLD is a ticker symbol that it basically represents gold, SLV for silver. So you can see in the past 5 years. Now, why do I look at the commodities? Because if you look at, I just looked at Chat and I typed in ChatGPT correlation between SPY versus gold, and you could see there's different analysis and different points of view, and you could see that. Sorry about that noise. The kid in the background, he's very excited about this. You can see that some people say that gold is about 0 point negative correlation to a very low correlation of 0.16, 0.25, 0.06, depending on where you look. But you could see that there's definitely somewhat of a correlation, but kind of low, or to maybe even negative correlation, but not necessarily. And again, they could vary. There could be dynamic. And we could look at silver. And also you could see that, basically I don't see negative correlation, but I see low correlation, 0.2, 0.24, 0.04. So pretty low correlation to the market, right? So if you notice over here in the trend that, Berkshire Hathaway moderately correlated, but much better return historically, gold, 94%, silver, 155%. There are times where gold beats silver sometimes, but it just depends on when you enter and what price you buy it in. But you can see they're keeping up. You know what I mean? So I added a business development company called BIZD. The reason why I like it, so it's a business development company. It's private equity, and that's why it's not perfectly correlated to the market. And you can see here, it keeps up. It's something that again, this is just things that I'm looking into. I'm sharing my research with you. 151% versus 153%. It's something that I don't mind having something that's invested, but at least I know I'm sort of getting some kind of return that's somewhere comparable in the total return standpoint. Now I threw in like JBBB and SGov, but it looks like JBB only came out like a few years ago. So we have to go to the 3-year chart to give a fair comparison. So if you look at JBB, you'll see 23% total return in JBBB. You look at SGov, 13%, 3 years. BIZD 31, SLV 32, gold, and then you can see here 38 for the SPY. But you could see that I'm trying to compare different types of and that's a CLO. So like I said, things I'm considering is commodities, precious metal commodities. I'm looking into basically CLOs, collateralized loan obligation, business development companies. I'm going to look into closed-end funds. I'm going to look into. I'm actually shorting the market a little bit here and there. I'm putting on temporary shorts with a combination of either long puts. Again, like I mentioned in my other videos, but I'm only doing it for short duration, or leverage inverse funds as well. But those are things that I'm putting on only for short duration because I don't want to short the market on a long-term basis. But for something to buy and hold to kind of like, kind of spread out the risk, I'm looking into these type of funds. If you guys know any other, items that are good and they have less correlation to the market or even some negative correlation to the market, but still, delivers comparable or somewhat at least 50% of the return on the market, let me know. I'm really interested in looking into these things. Anyways, this is the Working Investor over and out. I hope you guys have a wonderful weekend. All the best.